Hello, good morning, everyone. Welcome back to Automotive Logistics and Supply Chain Europe Live. Me, Christopher Ludwig. In the past year, we've all grown tired of the word unprecedented, but it's hard to describe what's been happening in the container shipping market as anything else. From early in the COVID crisis, we saw impacts of cancelled and blank sailings, and it's just been remarkable how much strain we've seen in that supply chain as economies restarted and adjusted to new buying behaviors. A few weeks ago, I think the Suez Canal was just the icing on the cake, as so many shippers were already feeling the impacts of high rates and longer lead times. So the question is, how long are we in for it? And what can we learn? Let's kick things off with a poll. So if I can ask you to go into the poll section in the main stage here. If you click there, then you should be able to see visible some poll questions which we want your opinion on. And the question is, have container shipping operations disrupted your operations over the past year, including logistics, manufacturing, costs, or inventory? The options are yes, container shipping has significantly disrupted operations. Yes, container shipping has somewhat disrupted operations. No, container shipping has had little to no impact on operations. Or no, container shipping has helped to improve operations. Let us know, have a vote now while you're going through that. And we'll share the results in a moment. So I can see you're starting to vote. As you're thinking through on that one, I'll ask you to look right down on the following question. How much longer do you expect disruptions in container shipping to persist? Do you see them persisting 3 to 6 months, 6 to 12 months, 12 to 18 months, 18 to 24 months, or more than 2 years? So let us know now how long you think this is going to go on. And whilst you're voting on that, let me just tell you a little bit about what's ahead in this session. We're going to be joined shortly by Philippe Damas, Managing Director and Head of Supply Chain Advisors at Drewry Shipping Consultants. Philippe is an expert in container shipping and will be giving us some really interesting data and outlook, which will address some of these topics here, and will join us for Q&A directly afterwards. So let's take a quick look at the poll. And we're just going to show the results now. Put in your last vote if you haven't already. And I think the responses may not be that surprising, that it's more than 83% or so say yes. And it's a dead heat between whether it was a significant disruption or somewhat disruption. So pretty strong disruption there, ranging from mild, let's say mild to max to high. So it's quite obvious there. And the answer here on how long it will last, it's pretty close, but it's more of you think 6 to 12 months is about where it's going to last. But it's, as I said, it's not too far behind with 12 to 18 months. But a quarter of people see it as a 3 to 6 month thing. So not necessarily for everyone a super long-term thing. Let's bring on Philip now. Philip, great to have you with us this morning, and thank you for joining us at Automotive Logistics and Supply Chain Europe Live.
Hello, Chris, and thanks for inviting me. Glad to be here.
Pleasure. So we saw some of those results from the poll. I know we have a couple of slides, so we're going to pull up those slides for you and hand over, and then we'll pick it up with some Q&A right afterwards.
Indeed. So I will share with you today our company's insight into some of the serious logistics bottlenecks and disruptions which we just discussed in your introduction, and also share with you our insight into the volatile market developments affecting international container shipping. So it will be just a few slides to give you some intro. In terms of credentials, Drewry Shipping Consultants, if you're not aware, we are one of the leading consultancy firms in international shipping, and we work for many exporters, importers, ports on a number of areas, whether it's benchmarking providers, benchmarking cost, or doing various studies or feasibility studies. And we do this through research and advisory. So next slide, please. So to the first part of understanding why container shipping supply chains are so disrupted now is to look back at what happened in the first half of last year. So if you try to zoom back to last year, there was China shutting down its production, the onset of a virus, problems, and a huge level of uncertainty. And the reaction of the shipping lines at that time was to cancel literally hundreds of sailings. They said there's a risk of a huge fall in cargo, nothing coming out of China for several weeks. Let's stop a large part of the network to ensure there's no overcapacity, to ensure we are still alive and survive at the other end of whatever happens. So you can see the top chart there shows you the really, and you use the word unprecedented, which I will repeat, I'm afraid, unprecedented number of cancelled sailings, which was quite a shock to the industry, and when the balancing system starting to go wrong. And then, although the expectation at that point, so again, first half of last year, were that there would be a collapse in volume, we saw that if you saw the chart at the bottom, there was a reduction in capacity in the first half of up to 24%, but very quickly the shipping lines realized actually the volumes were strong, in some cases even stronger than before the pandemic. So in the second half, we saw capacity being restored, but effectively not sufficiently. And that's where the system really got completely disorientated and disturbed because of a large bounce in traffic volume, which nobody had expected. So next slide, please. Now let's move to what I call the second wave of the pandemic. So here we realize that the volumes are actually very strong. There's a big bounce. Actually, there's a lot of volatility and a big swing in volumes. After some of the first half reductions, everybody was trying to replenish their inventory. And then we started seeing a real worldwide problem of port congestion and falling efficiency from mid-2020. And this situation is still continuing as of today. So the chart on the left, taken from Drewry's Ports and Terminals Insight, shows you what we define as the lengthening of vessel port call durations. How long does a typical container ship spend in port? And since 2019, you see the normal levels, and then effectively from the third quarter of 2020, you see the measurements go into the red area, which means the port duration is more than 2 standard deviations longer than normal. And you see it's really reaching critical levels of very long port durations, effectively very poor productivity, which is what we're seeing now. Very, very significant port congestion, which is lengthening supply chains, which is creating efficiency and huge costs across the industry. And because of this, worsening port efficiency in the UK ports, if you look at the chart on the right, you see that the shipping lines, because of this, decided they had to send fewer ships, in this case, to the UK ports. So that sort of compounded the problem. Not only are the ports less efficient, but you have fewer ships serving, in this case, the UK ports, and this has happened in other geographies. Next slide, please. Another way of looking at the current serious problems of disruptions in container shipping is to look at it from mainly the exporter-importer or logistics service company angle. And this is to do with schedule reliability. This is to do with the speed of equipment and ships. And this is obviously to do with costs. So I mentioned here 4 bullet points. The first one, which is obvious for anybody who is trying to get cargo and products moving with shipping lines, is that there's not enough ship capacity. It's really hard to ensure reliable, steady movement of your products because of not enough shipping capacity. On top of that, it's not just the ships. In container shipping, it's also the shipping containers, the boxes, and there's a serious shortage of shipping containers. And I will explain why. Because of these 2 problems at the same time, they are, as a user, as exporter, importer, or logistics service provider, chronic delivery delays and what we call rollovers. So instead of your container moving on the vessel, say next Wednesday, the shipping line will say, actually, there's no space. It will be rolled onto the ship a week later, Wednesday after. And then emergency use of air freight. I'm sure many of you are watching this, like one of our customers in the auto parts industry, providing to the OEMs, they had to spend over $100 million on air freight because the ocean sector was not coping. And then on top of that, you mentioned the problem, the blockage of the Suez Canal, which created an extra 1 week delay on top of the previous delays. So to sum up in the chart, bottom left, you can see in terms of schedule reliability, recently 66% of vessels were arriving late, and that's defined as within 24 hours of the scheduled arrival day, which means that only 34% of ships arrived on the expected day, which is all-time low and frankly disastrous. I also explained earlier the shipping containers, there was a shortage of it, and the reason for the shortage is that they are not moving fast. The velocity of shipping containers is affected by port congestion, affected by the shortage of truck or lorry drivers, affected by a number of other factors. So now it's taking as long as 100 days for a shipping container, for example, to go from origin in Japan to Europe and back, which is in some cases twice as long as normal. So you need many more shipping containers to move a given amount of products. And the third part of that chart here is referring to ships waiting at port for a berth. So they effectively are queuing. In February, I mentioned there were 25 ships waiting outside the port of Los Angeles. You had as many ships waiting as you had ships being worked in the port. And as of yesterday, I checked, there were 8 ships waiting outside the port of Los Angeles. So the situation has improved a bit, but still these ships are waiting 8 days before they get a berth. So again, waiting extra lead time of 1 week to add to supply chains. How about costs? So based on the Drewry container freight rate insight, you can see on the chart on the east-west, what we call the east-west lanes, costs are currently at a 15-year high. They have more than doubled in the year to March 2021. And some of you may know, if you, as a user, are desperate to move your products tomorrow, in the current market and recently, you were looking at 5-digit freight rates. So it was $10,000, $11,000 or more to move a container, which clearly can add a lot of cost to your budget. So the spot rates, so this is to move shipments outside the contract, have more than doubled in the year to March. And based on the Drewry benchmarking club, where we benchmark contract rates, so typically fixed contract rates for a year, we have seen increases of more than 50% in the year to April. So this is clearly a side effect of all these disruptions, all these inefficiencies, and the end users have to pay for these inefficiencies. Okay, next slide. Now, I'd like to share with you where we see the outlook. It was very interesting to hear the survey on the expectations concerning the duration of the current disruptions. First, I want to give you an idea of why this market is stressed. And in a way, it's a good problem to have because we are seeing very, very strong volumes this year. The container shipping market has never been this hot. Okay, there are a lot of operational problems, but clearly global trade is thriving now for all the commodities and products, not just automotive. So if you look at the chart there, you can see very strong growth rates this year. This is taken from a container forecaster. So, nearly 15% for South Asia, double digits for North America, Oceania, Europe, 5 to 10%. Asia, which is by far the biggest region for container volume, also growing close to 10%. This is higher than the historical average over the last 5 years. So Asia region, again, so plus 9%, Europe plus 8%. This does not affect all the trade routes. We're seeing much faster growth on some trade routes, like, for example, routes into the US are extremely hot. Intra-Asia is very strong, but Asia to Europe is one of the slowest moving routes in terms of growth. And next slide. And then now the question is, how long is this shortage of capacity going to happen? So here I have to explain a few things. First, we have to measure clearly supply and demand. The supply has to take into account the velocity of assets, which today, actually the poor velocity or poor productivity of assets is affecting the supply more than the change in the number of ships in the system. It's really how slow or how fast these ships are moving. So in this chart, under capacity means reading above 100. Clearly, we are in a clear situation of under capacity. And you see that in previous years, we came from years of chronic overcapacity. So this system has changed. Now, looking to the next few years, we believe that the asset velocity will gradually normalize. So we see that normalizing from the end of this year and next year, which will bring the supply demand into better balance. But I have to stress that there's another factor which is not represented here, and this is the change in behavior of the carriers. For the last few years, we at Drewry have seen and said many times that the carriers are no longer willing to tolerate and provide plenty of surplus capacity, plenty of reserves of capacity to the industry. Now, the way the carriers are managing their networks is that, yes, they have some capacity, but they will not deploy all the capacity. They will deploy only what's needed through cancel selling, through capacity management. So even though the capacity may increase, the number of ships may increase, the actual capacity in the system may not increase by as much. And this is why we are saying in 2022, we will see fewer disruptions, a better balance between supply and demand, but we will not see a return to chronic overcapacity. We think there's been a structural shift. And this was to so finally give you a view that for us, we see the disruptions at Drewry lasting until most of 2021. So we see it more as a 6 to 8 months issue, not a 3 to 6 months issue. Some of the shipping lines are saying they hope that the situation will improve will improve from Q3 at the earliest, but still as of today, there's a huge amount of uncertainty. If we talk to many people, nobody is quite sure how long it will take. Our best reading at Drewry, speaking to carriers, and forwarders and ports, is that you're looking towards the end of 2021 to see a normalization. And that was my early presentation. So now I look forward to moving to the Q&A.
Philippe, thank you so much for sharing that data and insight with us. I think it offered at least some hope, and it aligned pretty well actually with some of our audience voted on there in terms of how it may play out over the coming months. But let's sort of start with that light at the end of the tunnel, so to speak. You illustrate how the industry is likely to manage its capacity much more closely to avoid those chronic overcapacity. But that still looks to me like on your graph there, a pretty sharp drop as it moves through this year. I mean, what is the main driver for that? Is that basically ships coming off of layup? Is it some new capacity? Is it other slackening in trade? I mean, what do you see as the kind of main driver there?
Yes, so it's not all the ships are effectively out of layout now. So the shipping lines have thrown all the ships and all the containers they had in the system. They have started ordering actually a very large number of new ships. You may be aware that the order book now has increased. I think it's virtually tripled in the last 9 months. But these new ships will not be delivered for 18 months or so. So that will not make the difference. What will make the difference, in our view, is that there will be fewer COVID restrictions on labor. So on port workers, now there's a shortage of port workers. On truck drivers, so the system will start to flow a bit better. And also we think we are moving to a bit more regular patterns of trade. So you will not have these huge swings between, as I showed, first half of last year, huge fall in traffic, and then the second half, a huge surge in traffic. So more regular patterns will enable the shipping lines to absorb the all the waiting cargo and all the congestion.
And I would assume that as that balance is better found, that the rates will drop commensurately. But do you see them coming down as significantly, or are they sort of likely to remain fairly high by historic levels?
Okay, so that's a great question. So for spot rates, we are convinced that the spot rates will have to fall next year. And it could be, 30, 40, 50%, so a significant fall. However, spot rate is still a minority of the business, maybe the most visible part. But the main question for many of the OEMs in particular is that they ship with contract rates, and we do not see at all a return to pre-pandemic freight rates. So, we provide forecasts of rates on trade routes. We see that there will be typically a 40% difference between 2022 contract rates and, for example, 2019 contract rates. So it's a significant change, frankly, in the cost of container shipping. There will be a return to some periods of overcapacity, so these rates will change, but we think we're moving to a new level of freight rates where the carriers effectively are much more disciplined and making much more money.
That is, as you've noted, quite a significant change, structural change in the cost of shipping, particularly perhaps here for automotive, because as you mentioned, they're on contracted. Do you see that leading potentially to other wider changes in use of container shipping, whether it's in routes or even shifts to other transport modes where it might be possible?
Yes, so we have discussed this question of nearshoring versus remote production for years now. Frankly, it hasn't happened as yet. For example, we see a lot of many people are saying China, for example, will fall as a producer of products, which really hasn't happened. If anything, China has strengthened. But there are risks, and I think people are more aware of the risk of remote production. So I can see a number of producers saying, I have to take all these factors into account. The cost of shipping is becoming significant. There's a greater risk that I may have to move air freight, which is even more significant. So I think there will be some near production, maybe to North Africa, Eastern Europe, and so on. Probably not a huge change, but I'm sure that will be debated for many years. But certainly people are more aware of the risk of long supply chains now.
Yeah, and I think, again, when we put it in the automotive context, as the Suez Canal, I'm called the Suez Crisis, I should get my history correct there, the Suez Canal blockage the other week, clearly we know the automotive industry operates on lean inventory models, and these disruptions clearly have put some strain on that. I mean, you mentioned the localization potential and shift. Do you see, or in what you're seeing from customers in automotive or other, questioning of some of those inventory models as well?
Yes, so Suez Canal is a really interesting example, but we have to put it in context. So, Suez Canal is one of our customers for disclosure. So you may treat my comments with a bit of skepticism, but there have been 20 groundings of container ships in the last 10 years out of 180,000. So I'm not sure exactly what the ratio is, but it is very, very small. And I also speak to some OEMs, and they say, if I have a significant grounding every 10 years, I can live with it. That's part of the planning. Yes, I have to activate some contingency plans. Yes, I have to move air freight. It can be very costly, but it's less costly than expecting that moving my production to higher cost area, which will happen every single time. So I think it's the usual planning of supply chain risk and balancing that with supply chain costs. I think people are more aware. They have to take into account that disruptions, frankly, they are becoming more frequent. For us, container shipping, we had, we have a Suez Canal, we had various attacks, cyber attacks on shipping lines, blocking everything. We had port strikes. Now, disruptions are not exaggerated a bit earlier. Suez Canal had disruption maybe every 50 years, but there's at least one type of disruption maybe every 3 years now, I think. So it has to be taken into account in the planning. I don't think it's going to be making a huge change in where we deploy the network, but it is a factor.
It's a very, very good point there around the contingency that needs to be built in on that. But nonetheless, some of what you've shown clearly with some of the service levels and pretty shocking statistics that you showed there in terms of delayed. I mean, I don't think anyone would be proud to be standing up next to them. But what do you see exporters and importers doing to address that lack of reliability right now in the maritime supply chain?
Yes. So now the problem, the one we work for over 100 exporters and importers, and when we have discussions with them, their number one problem is, how do I secure my capacity from the shipping lines? I cannot continue to have a complete lack of visibility on when my products will be delivered, or when the products will be loaded. So part of this is to accept that the service levels are poor. There's not enough capacity. Frankly, there's not much you can do about it. But now there's a much greater interest in working more closely with providers, monitoring them much more closely, having much data visibility systems and monitoring. So there's a lot of work being done on mutual commitments. For example, if a carrier cannot ship on loop A, you can either ask them or ask your service provider to look for an alternative or have a trigger to do something. And then you also need to develop better key performance indicators, better data monitoring, better carrier management, and ensure that there's a true relationship between the shipping line and the shippers and the exporters, importers.
One of the factors likely in response to that overcapacity that we'd seen in the run-up to the current crisis was a lot of consolidation, alliances, for example, out of Japan. Do you see that pattern continuing now as we slowly kind of balance in this phase? Or there's an opportunity for change or even other players to gain market share in this disruption?
As of now, we think the consolidation has effectively finished, and it's taken maybe 30 years for the industry to reach the current level where A, you have just 8 major container shipping companies, and B, these 8 shipping companies are in just 3 alliances. So I don't think you can go much fewer than 3 alliances. And I think if you had fewer than 8 major shipping lines, the regulators will start asking some serious questions. There may be room for some regional trades like intra-Asia for new entrants, but frankly, on the global level, the investment amounts are so huge that it's nearly impossible now for a new entrant to attack and get a market share against these top 8 providers.
Yeah, that makes total sense. Maybe just a last question here is perhaps just bringing the automotive sector a little bit more into context with the global container shipping. I think it was interesting what was noted, how in the recovery last year, things like e-commerce, home appliances, all this was for driving so much trade. Do you see automotive as being a base freight for the container shipping market is a really important bit of it, or do you see it sort of losing some priority in the global mix?
I think it is losing priority. Typically, for example, transatlantic trade, the car producers were one of the top steady base cargo providers, but in the current market, where it's effectively a seller's market, a shipping line market, we are not seeing the OEMs getting as much power in the relationship and as much priority. So I think it's mainly a negative for the shipping lines. They they have to pay more, and they have to become what we call a shipper of choice. They have to find ways to convince the shipping lines that their cargo is important, which is a complete reversal of the previous relationship.
Well, Philip, thank you so much. This is some really fascinating data, and I think those insights are really valuable for this audience. And I think that message as well around being a shipper of choice, how the relationships need to evolve and change will be really critical here. Thanks again for all of that. If our audience has other questions, please engage with Philip and his colleagues. We're happy to make connections. Lots more data to share there. So Philip, thanks again so much.
Thanks so much. I look forward to Q&As with different audience. Thank you. Goodbye.
Absolutely. So thanks again to all of you for tuning in. We'll take a really short break and we'll be right back. Thanks for staying with us here at Automotive Logistics and Supply Chain Europe Live.